To shrink the military was to invite invasion or a coup. To cut the grain dole was to invite riots, so they chose the third option. They chose the monetary shortcut. It began almost imperceptibly under Nero in 64 AD. The silver content of the denarius was reduced from roughly 98% to 93%. It was a small shave barely noticeable to the average shopkeeper in the forum, but it was the crossing of a Rubicon. Once the state realized it could reduce the silver content and still mandate the coin be accepted at face value, the floodgates opened. The incentive was to debase. By the time of Septimius Severus in the early 3rd century, the silver content had collapsed to roughly 50%. Think about what that means for the saver. A centurion who had saved his pay for 20 years found that his savings, if held in the new coins, commanded half the purchasing power of his grandfather's savings. But the real crisis arrived with the Antoninianus, a double denarius coin introduced to mask the inflation by the mid-3rd century. Under the Emperor Gallienus, the silver content of the currency had plummeted to less than 5%. The coins were no longer silver. They were bronze slugs dipped in a thin wash of silver that would rub off after a few weeks of handling. The reaction of the market was swift and brutal. This is the part of history that directly maps to the U.S. Mint's current struggles, as the quality of the new money degraded the old money. The pre-Nero denarii, the coins with high silver content, disappeared. They vanished from circulation. Merchants, soldiers, and ordinary citizens hoarded the old silver and spent the new worthless bronze. This is Gresham's law in action. Bad money drives out good. The Roman state tried to force acceptance. They issued edicts. They threatened capital punishment for those who refused the new currency. But the economic laws overrode the imperial laws by the time Emperor Diocletian issued his famous edict on maximum prices in 301 AD. The system had fractured. Diocletian attempted to fix the prices of over 1,000 goods and services, from a bushel of wheat to the wages of a camel driver. The penalty for violating the price controls was death. The goods disappeared. The economy collapsed into a barter system. The complex trade networks that spanned 3 continents disintegrated because there was no longer a trusted medium of exchange. The silver had gone into hiding, waiting for a reset that would take centuries to arrive. The lesson from Rome is foundational. When the state debases the currency to pay its bills, the physical metal flees the system, leaving the public with paper promises, or in Rome's case, copper slugs, that eventually return to their intrinsic value of 0. The pound was defined as a specific weight of silver and later gold. But the costs of World War I shattered the British balance sheet. The war required resources that the British tax base could not provide. The silver value of the coins in circulation was approaching their face value. This is the melt value crossing the face value. To prevent this, the British government passed the Coinage Act of 1920. Overnight, the silver purity of British coinage was slashed from the historic 92.5% sterling silver down to 50%. It was a massive default on the currency. Disguised as a technical adjustment, the public was told it was necessary for the stability of the realm. In reality, it was a confiscation of wealth. The government took the old sterling coins, melted them down, extracted the excess silver to pay war debts to the United States, and reissued coins with half the precious metal. But the pattern did not stop there. The incentive to debase is a one-way ratchet. By 1946, following the devastation of World War II, Britain was bankrupt again. The pound was under immense pressure. The price of silver was rising again. In 1947, the British government removed all silver from the coinage completely. Consider the experience of a shopkeeper in London during this transition in 1914. The coins in his till were storehouses of value. By 1947, they were tokens of debt. The name of the currency, the pound sterling, remained the same. The symbols on the coins remained the same. The monarch's face remained. On the obverse, those who held physical silver antique plate pre-1920 coins bullion preserved their purchasing power. Those who held paper pounds or the new base metal coins saw their wealth evaporate in the inflation of the 1970s that followed. The final debasement. The British example teaches us that the removal of silver from the monetary system is not a sign of modernization. It is a sign of bankruptcy. It is the state admitting that it can no longer afford to put real value into the hands of the people. Just like the Roman Empire and the British Empire, the Weimar Republic provides the most violent and compressed example of this phenomenon, showing exactly what happens when the disconnect between paper and silver reaches its mathematical limit. Weimar Germany is often cited for its wheelbarrows of cash, but the silver story is the one that matters for us today. Prior to World War I, the German mark was gold-backed and circulated alongside silver coinage. The government began printing paper marks to buy foreign currency to pay reparations and to subsidize striking workers in the Ruhr. The speed of the collapse was breathtaking. In early 1921, a silver 5-mark coin could still buy a decent meal. By 1923, the paper price of that same silver coin was in the billions of marks, but here is the key detail that is often overlooked. The silver did not lose value. The silver coin didn't change. It still bought the same amount of bread, the same amount of coal, the same amount of labor. It was the paper that was gyrating wildly into oblivion. There are accounts from the period of families who had preserved a modest amount of silver cutlery or old coinage, while their neighbors were selling grand pianos for a sack of potatoes or trading family heirlooms for a train ticket. Those with silver could operate outside the collapsing system. 1 ounce of silver became a lifeline. It was the only asset that the farmers in the countryside would accept. They would not take the paper marks, which lost half their value by the time they could drive to the bank. They wanted hard assets. The Weimar government, seeing the flight to real assets, attempted to crack down. They implemented strict capital controls. The Weimar example proves that when confidence in the sovereign debt evaporates, the price of silver in the local currency becomes meaningless. It goes to infinity. The only thing that matters is, do you have it or do you not? The pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is backed by or composed of physical metal. Trust is high, inflation is low, and the economy grows based on production and savings. Stage 2 is overextension. The state takes on obligations it cannot fund through taxation alone, usually war or massive social entitlement programs. The budget deficit becomes structural. Stage 3 is debasement. The state begins to dilute the currency. In the ancient world, this meant mixing copper into the silver melt. In the modern world, it means quantitative easing and expanding the central bank balance sheet. The stock market soars, real estate climbs. But the cost of living begins to creep up, eating away at the middle class. Stage 5 is suppression. The state realizes the inflation is becoming a political liability. They intervene to suppress the signals. They use the paper futures markets to sell unlimited paper silver or paper gold to keep the headline price of the metals low. Masking the devaluation of the currency. Stage is shortage. the system can no longer sustain the divergence, the currency is either revalued significantly lower against the metal or a new currency is introduced. Wealth is transferred from those holding paper to those holding assets. They are being priced out of the real market even as the paper market claims the price is stable. Skeptics will argue that this is temporary. Meanwhile, the demand side is undergoing a structural shift. Solar panels, electric vehicles, and high-end electronics are consuming silver at a rate that history has never seen. The central banks managed to keep the inflation rate high but stable 4 to 6%. For a decade, they slowly erode the debt. In this scenario, silver grinds higher year after year, acting as a shield against the slow theft of purchasing power. This mirrors the post-World War II period in the West. The second is chaotic collapse. The bond market revolts, yields spike. The central bank is forced to print trillions to save the government from default. The currency enters a hyperinflationary spiral. The major powers gather, as they did at Bretton Woods in 1944, and agree to re-anchor the global financial system. Educate yourself on the difference between paper promises and physical ownership.